If you're looking to buy a house, or you've got a mortgage, the RBA has just made life even more difficult for you. They've raised the official cash rate by another 25 basis points, taking the cash rate to 3.35%. Now, of course, this was relatively unsurprising. Headline CPI inflation came in at 7.8% in the latest reading, up from 7.3% in the prior reading. Inflation is running incredibly hot. Now granted, much of this inflation data is quite stale. It's coming in with a bit of a leg, so it is really quite backward looking. But the RBA is going to be cognizant of it when it is setting its cash rate policy. Not only that, overseas central banks have also been hiking rates, and the RBA therefore needs to follow suit lest the Australian dollar come under significant pressure. After all, if the Federal Reserve hikes rates, but the RBA doesn't, the US dollar might ultimately surge, which is going to make imports even more expensive in Australia and could then import inflation into Australia. So recently we saw the Federal Reserve hike rates by 25 basis points, the ECB by 50, and the Bank of England by 50 basis points. So the RBA also needed to do something against this backdrop. One thing that the RBA does however need to consider is how different Australia is from the United States, for example. In the United States, many mortgages are 30-year fixed-rate mortgages, meaning that a rate hike has a relatively muted impact on the consumer. By contrast, in Australia, the fixed-rate term is often only a couple of years, and many fixed-rate mortgages are going onto their variable term in the near future. This means that even a small rate hike can have a significant impact on many borrowers, which can significantly crunch consumer demand and have a major impact on the economy. Hence why the RBA needs to be a little bit more cautious, perhaps, than the Federal Reserve might be. So that's what we're seeing going on with rates. The next question, however, is how these rate hikes might affect the property sector. These rate hikes are probably not great news for property prices, but ironically enough, they're also not brilliant news for property buyers. So let's have a look at the exact ways in which rate hikes might impact the property market. The first one is through borrowing capacity. Whenever rates go up, your borrowing capacity decreases. So say for example rates are going up 25 basis points, then all of a sudden your mortgage gets more expensive. Banks obviously realize this. So in the past, the bank might have assessed your borrowing capacity at $1 million. But now when rates have gone up, they'll assess it at $950,000, especially if they're expecting more rate hikes in the future. And therefore people can afford to pay less for a property, and as a result demand will decrease for properties, which can put some downward pressure on property prices, assuming supply also doesn't decrease. The next issue is through potential distressed sales. So many homeowners in Australia are looking at facing a fixed rate cliff. That is, they might have had a fixed rate mortgage, but that fixed rate mortgage is expiring and they're going to shift onto much higher variable rate mortgages. Some of those property owners might not be able to properly afford those variable rate mortgages, which might cause some distressed sales, maybe some urgent sales, maybe some people trying to exit the properties that they can't any longer afford. Now, we're not likely to see this immediately necessarily. Many people will try to muddle through in their higher mortgage for a year or so if they can afford to do so. And then when the rates are being cut, they might then be able to actually afford it again. But nevertheless, we are going to see some properties coming to the market that are perhaps a little bit distressed. This might give rise to some pocket deals where people can see pockets of value that emerge at various points in time, even if this isn't broadly across the market, which can give rise to some good bargains, and people might be able to buy some properties at a slightly lower price. However, we need to consider the converse, which is what is going on with supply. Many property owners are reportedly holding up bringing their property to the market. They've seen property prices have gone down a little bit, they've seen the interest rates have gone up a bit, but now they're waiting for those interest rates to pause and potentially go back down before they consider selling. And as a result, many owners who are not distressed have withdrawn their properties from the market, which is what we've seen with some of the auction levels at the moment, where perhaps in some weeks there haven't been quite as many properties coming to the market, which has to some extent, conversely enough, actually supported prices. But nevertheless, we are generally seeing this confluence of a reduction in borrowing capacity, plus some potential distressed or at least nervous sales going on, which has caused some supply for cheap properties coming to the market, some reduction in demand, which has slightly shifted down prices and is potentially going to continue to shift down prices, at least according to economist forecasts. I, however, don't personally see property prices dropping off the edge of a cliff because many owners who are not distressed are simply going to wait it out, particularly until interest rates start to decrease. The next question is then, what should you do about property buying? Well, here we're really just crystal ball gazing. We don't know for sure what the RBA is going to do, nor what any other central bank is going to do. But what you might look at is you consider how many additional rate hikes is the RBA going to do. Consider this in the context of inflation data that comes in and what the other central banks are doing. So you can look at that, and then you can think, well, when is the RBA potentially likely to pause? And if one were to buy a property just before that pause, or just before the rates are actually cut, that might be a decent time to buy. After all, when rates are cut, people might see that we're at the end of the hiking cycle and might feel more confident to go back into the market, believing that interest rates are going to decrease a little bit. So if one can get in just before that, one might pick up some reasonable bargains with some uplift. At least if you are buying strategically and creatively in a way that is going to have some upside, in areas that are going to have general demand support, not areas that are necessarily in the middle of nowhere, that will generally suffer from weak demand, but in areas where there's generally strong demand due to supply constraints and or people coming back into the market as people are returning from overseas. So in general, these rate hikes aren't great for property prices. They're also not great for borrowing capacity, but we do see some light at the end of the tunnel because there's only so many more rate hikes the RBA is actually going to be able to do. But if you've got any thoughts about it, let me know that in the comments below. But otherwise, thanks so much for tuning in, and hopefully I see you for future videos as well.